Welcome back to another video. Today we are going to cover the most important ICT concept there are, from buy-side liquidity, SMT, fair value gaps, inversion fair value gaps, market structure shifts, and change of a state of delivery. These are honestly one of the most important ICT concepts that there are. Create any strategy you want with these proven concepts. So let's not waste too much time. I'm gonna get right into the video and I'm gonna show you exactly what every single model is in depth. Starting it all off, buy-side liquidity. Why is this so important? Well, buy-side liquidity is pretty much a zone. Think of it as a very popular food market, like Black Friday. Now, when those stores open, what's everyone gonna do? They're gonna flood into the market and they're gonna buy everything because it's on special. I know it's kind of a silly example, but honestly, it makes perfect sense. So the second you see a new high get taken to create a new higher high, now a bunch of people that want to short the position, whoa, I can't even speak. Everyone put their stop loss right above these highs. So the second we come up and we sweep these highs, what are we gonna do? All those orders, everyone is gonna rush into the market and they're gonna short this position. So let's see what happens. The second we come into the zone, right away we push right down. So that is a perfect example of what buy-side liquidity is. Now, let's look for sell-side liquidity. Right here, what do we see? This is the lower low. Now, what do? Well, same analogy as the first one. When people come into the zone, a bunch of people, the stores open the second we pass the zone, and what are they going to do? They are going to flood the market. So let's see what happens. They come in and bang, tap. Markets open, everyone jumps in. Now what do? Well, I hope you know the answer now. The sell-side liquidity gets swept, we get bought up. Now, what do we do again? Again, on this buy-side liquidity, what do? We push back down. Guys, it's honestly as simple as that. This is how you know that once a buy-side liquidity gets taken, it's going to get swept and it's going to tank down. Vice versa. Let's say if a new lower low gets swept, it's going to push all the way up. So that's also a good way to tell your daily bias. Now for SMTs. So SMTs are just divergences in the market. So once you have NASDAQ and S&P, which are two correlated assets, when one makes a new high to a low and one makes a low to a high, there's a divergence, meaning that the assets are going to go either down or up, depending on where the SMT is. For example, in this example right here, when NASDAQ and ES, right here, we have an SMT. So since we have an SMT at the highs, what is that telling us? Since we have the SMT at the highs, we are going to push down. Vice versa, if we had an SMT at the lows, which we actually had right here, this wasn't even planned. Right here, we have this SMT. What do? Second it gets placed in, we get bought up. Now, at the top, we have an SMT on the highs. What are we going to do? Well, I'll let you figure that one out. We get bought all the way back down. So that is simply what an SMT actually is. It's really not difficult. So for example, again, I'll explain it. SMT, right here, we're making a high to a low. Right here, we're making a low to a high. And what do? We get bought up. What do we do here? From a high to a low. On ES, S&P, we make a low to a high. What do? We get selling off. So that is what an SMT is. Now, let's move to fair value gaps. Fair value gaps are just inefficiencies in the market that have to get refilled. So for example, say we have a very strong move that happens in the market, oftentimes it leaves a gap. So what happens after that is the market always tries to come back, retrace into that gap to then fill those orders and then continue its trend downwards. And it always happens between 3 candles. For example, right here, what do we see? Well, we have, let's zoom in a bit. We have 1, 2 candles. And let's keep an eye on their wicks. What do we see with the wick? One wick ends right here. One wick ends right here. What does that make? a gap. So once we see this gap get put in place right here, we draw out our little rectangle. Now, what do? The second we come into the zone, what can we expect? We can expect a big sell off, which we do right here. So instead of the market actually continuing its trend downwards, what do? We come back into the zone, fill all of those inefficiencies to then continue our trend downwards. Now, let's look what an inversion fair value gap. It's very similar. So for the inversion fair value gap, which is very similar as to what a fair value gap is, once again, what do? We see 1, 2, 3 candles. Where are the wicks? Right here, right here. So let's draw our little rectangle right inside, in between those wicks, just including the body candle of the middle candle between the 3 down closed candles. I just said candles there a lot. I hope you caught on. Now, what do? Well, for an inversion fair value gap, we would wait right for this break to happen. Once that break happens, then we don't enter right away. We wait for a retrace. Once that retrace happens, then right away, we continue our trend upwards. So an inversion fair value gap, the difference between a fair value gap and an inversion fair value gap is simply once we come into the zone, instead of rejecting down, what a fair value gap would do, we actually break a full body close right through it. We retrace to fill the gap, and then we continue our trend in the opposite direction. So instead of retracing back down with a fair value gap, we break right through. Now, just for the sake of the video, I'll combine on the last step what a change of steady delivery is and a market structure shift, since they are very similar. Now, change of steady delivery and market structure shift is just a reason for the market to reverse. So say we're kind of pushing into an uptrend and we want to see a rejection to continue in the opposite direction of the market. This is what we would use as an entry model to catch reversals in the market. So for example, right here, we have a manipulation leg, meaning once we make a strong push to make a new high, sweeping this previous high, right here with this wick, we made this new higher high with the high. That means what we want to look for is either a change of steady delivery right here or a market structure shift right here. Now, you may ask, well, what's the difference? Well, a change of steady delivery goes right below the last candle, which would actually be right here. My apologies. The last push to make the new high right below the body close. Market structure shifts go on the last low of the candle of the wick close. So market structure shift would be right on the wick, and change of steady delivery would be right on the body close. And what do? The second we make a full body close past those two zones, you would take your short position, as the trend has confirmed that we are going in a downtrend, which we do right here. Now, guys, I just showed you exactly what a buy side liquidity is, market structure shift, change of steady delivery, fair value gap, inversion fair value gap, and an SMT for completely free. I didn't ask for $1 single. What I do ask is for you just to leave a like and subscribe just to support the channel. Also, I really do hope this made sense to you. I hope you enjoyed the video. I hope you made it to the end. If you did, leave me a like and let me know down below what you want to see next. Also, guys, I really do appreciate the support. And just to let you know, down below, I have my Discord. It's completely free. It's just a place to chill and talk during New York session, since trading could be a bit lonely. So I hope you have a beautiful, beautiful day, and I hope to see you next time. Peace.